In most countries, when you start a business and begin making money, you have to share a portion of that money with the government. It does not matter to the government if you worked long hours, took risks, or built everything from scratch. Once your business becomes profitable, a percentage of that profit is expected to be paid as tax. And therefore, in this video, we'll dive deep into what exactly is a corporate tax, how it works for companies, the myths, pros and cons, compare countries, and finally explain why it even exists. So without further ado, let's get into it. Let us start with the basics. Corporate income tax is simply the amount of money a business pays to the government based on the profit it makes. The key word here is profit, not revenue. Revenue is the total amount of money a business brings in from sales, but profit is what remains after all the costs are paid. So if a business earns $100,000 but spends $80,000 on expenses like rent, salaries, and materials, then the profit is $20,000. Corporate income tax is applied to that $20,000, not the full $100,000. A helpful way to think about it is this. When you work a job, you pay income tax on your salary. When a business operates and earns profit, it pays income tax on that profit. It is the same idea, just applied to a company instead of an individual. Almost every country has some form of this tax, because it is one of the main ways governments collect money to run public services. Now let us break down how corporate income tax actually works in practice. First, who exactly pays it? Any registered business that earns a profit is generally required to pay corporate income tax. This includes large corporations and, in many cases, smaller companies as well, depending on how they are structured. Next, when is it paid? Most businesses calculate their taxes once per year. They look at all the money they made, subtract their expenses, and report the final profit to the government. Based on that number, they calculate how much tax they owe. In some countries, businesses also make smaller payments throughout the year to stay on track. Now, how is it calculated? The basic idea is very simple. You take the profit and multiply it by the corporate tax rate set by the government. Here's a clear example. Imagine your business made $200,000 in revenue this year. After paying all your expenses, you are left with $50,000 in profit. If the corporate tax rate is 20%, you would pay 20% of $50,000, which equals $10,000 in tax. After paying that tax, the remaining $40,000 stays with the business. That money can be reinvested, saved, or distributed to owners. While real tax systems can include deductions and special rules, everything always comes back to that core idea of profit multiplied by a tax rate. Now here's something that surprises a lot of people. Governments do not always try to collect the highest possible corporate taxes. In many cases, they intentionally lower corporate tax rates. This might sound strange at first, but there is a reason behind it. Businesses create jobs. When companies grow, they hire more employees. Those employees then pay income tax on their wages. So instead of taking a large amount directly from companies, governments sometimes choose to take a smaller amount and encourage businesses to expand. Over time, this can lead to more jobs and more total tax revenue from workers. Another thing people often miss is that businesses do not always absorb the cost of taxes on their own. Companies can adjust their behavior. They might increase prices, reduce expenses, or move operations to a different location. Because of this, the effects of corporate tax can spread beyond the business itself. Customers, employees, and investors can all feel the impact in different ways. This is why corporate tax is such a debated topic. It is not just about companies paying money, it affects the entire economy in ways that are not always obvious at first. Now let us look at the advantages and disadvantages of corporate income tax so you can see both sides clearly. First, the advantages. One major benefit is that it generates revenue for the government. This money is used to fund things like infrastructure, healthcare, education, and public services. Without this funding, many of the systems people rely on every day would not function properly. Another advantage is fairness. A lot of people argue that employees should not be the only ones paying taxes, and for that reason, among many others, governments use corporate taxes to create fairness. This, in theory, helps create a more balanced system. A third benefit is that it can help reduce inequality. By taxing corporate profits, governments can redistribute some of that wealth into public services that benefit a larger portion of society. Now for the downsides. One disadvantage is that high corporate taxes can discourage investment. If businesses feel that too much of their profit is being taxed, they may choose not to expand or may move their operations to countries with lower tax rates. Once it's done, that new country usually is the one creating more jobs and collecting more money through taxing their workforce. Another issue is that it can reduce job creation. If companies have less profit available, they may be more cautious about hiring new employees or increasing wages. A third downside is tax avoidance. Many companies look for legal ways to reduce the amount of tax they pay. This can make the system more complex and sometimes unfair, especially for smaller businesses that do not have the same resources to navigate these strategies. Overall, corporate income tax involves trade-offs. It provides important benefits, but it also creates challenges that governments have to manage carefully. Now, corporate tax rates vary a lot from country to country, and each approach reflects different priorities. Some countries have higher corporate tax rates because they rely more heavily on tax revenue to fund public services. These countries often have larger government programs and need more funding to support them. On the other hand, some countries choose to keep corporate tax rates low in order to attract businesses. Lower taxes make it more appealing for companies to invest, open offices, and create jobs in those locations. This strategy can help boost economic growth and increase employment. Then there are countries that aim for a middle ground. They try to balance generating enough revenue with staying competitive in the global market. If taxes are too high, businesses may leave. If they are too low, the government may struggle to fund essential services. So corporate tax is not just about collecting money. It is also a tool that countries use to compete with each other and shape their economies. Now, let's talk about why it exists. At its core, corporate income tax exists to support the system that allows businesses to operate in the first place. Companies rely on public infrastructure like roads and transportation systems to move goods. They depend on education systems to provide skilled workers. They rely on legal systems to enforce contracts and protect their rights. All of these things are funded by taxes. Corporate income tax is one way businesses contribute to maintaining and improving that system. It also plays a role in balancing economic power. Without taxes, profits could become highly concentrated, and there would be fewer resources available for public services. By collecting taxes from businesses, governments can invest in areas that benefit society as a whole. This includes infrastructure, healthcare, education, public safety, and many other essential services. So while it may seem like money leaving the business, it is also part of a larger system that supports economic activity and stability. The takeaway is this: when a company makes profits, in most countries, it is required to pay taxes to the government. The government then is supposed to use that money to fund social programs or other sectors of the economy. Most of the time, corporations are less taxed than individuals for the same amount of money, because corporations create jobs which boost the economy as well as increases tax revenue through individuals. If this video helped you understand corporate taxes more clearly, give this video a like and watch one of the videos showing on your screen right now. I'll see you on the next one.